This classic 1970s commercial is the sound of the Coca-Cola company selling a lot of Coke and making a lot of money. And that's the sound of the Coca-Cola company losing a lot of money. In 2020, a U.S. tax court ruling found Coke had underreported income from transactions between its overseas units. The court later ruled that Coke owed about $2.7 billion, though with interest, it swelled to $6 billion.
Their trademarks and their intellectual property, their recipes, their patents.
Coca-Cola is appealing the decision, but it's not just Coke.
Microsoft has almost $29 billion that the IRS is trying to get back. Meta's $15 billion.
Such is the high-stakes world of cross-border transfer pricing, where multinational companies set prices for transactions with and between their own subsidiaries.
If you're a company and you have a subsidiary in another country and you want to ship them goods to sell in that country, the price you charge and thus where you record that profit can make a big difference in where you pay those taxes.
Now, as governments around the world look for more tax revenue to fund public priorities, tax agencies are increasingly scrutinizing this technical and potentially lucrative source of revenue.
The dollar amounts that are at play in these tax disputes have gotten ginormous.
As multinational corporations grew and expanded in the early 20th century, countries recognized a need to address transfer pricing issues. Early regulations emerged during World War I as part of broader efforts to prevent tax avoidance and protect wartime tax revenues.
Companies had subsidiaries all over the world. It's getting really hard to track what's going where's the profit being generated.
As companies grew in size and complexity, so did their profits.
That means you could be missing out on potentially billions of dollars in taxes. Across multiple companies, that can add up really quick.
So, how do regulators ensure assets transferred between subsidiaries within a multinational company are taxed fairly? One solution, the arm's length principle. That is, when one entity sells or transfers goods, services, or intellectual property to another entity in the same company, they should charge a price comparable to what they would charge a third party.
You want to do it as if these are unrelated parties.
Today, most countries have codified some form of arm's length rule, and it's a key pillar of international tax rules.
In the United States, Tax Code Section 482 is where you'll find the transfer pricing rules.
So, how do companies calculate their transfer prices? And how do they know they're getting them right? It's complicated. Take that frosty, delicious Coke.
Coca-Cola, when they are doing business around the world, they need to think about transfer pricing when it comes to sending ingredients overseas, bottling manufacturers, marketing costs and sales, and what's the value of their trademarks and their intellectual property, their recipes, their patents, every step on the chain.
It's one thing for the Coca-Cola company to price tangible goods like bottles and ingredients. But it's another to price the intangible goods, like trademarks, copyrights, and secret formulas.
Transfer pricing disputes have really heated up as the economy, the global economy even, has become much more based in intangible assets. Practitioners, accountants, lawyers, they really think of it as more of an art than a science. There's very rarely, if ever, kind of a very clear cut, this is the number.
It's like the game show, The Price is Right. Except, instead of Bob Barker telling you the price is wrong, it's the IRS.
If the IRS thinks a company is doing something wrong with their transfer pricing, they'll do an audit and they'll say, you need to give us a transfer pricing report and a lot of information and data detailing how you're pricing your intercompany transactions.
And it's not just the IRS that companies worry about. They must document their case to tax authorities all over the world. At its core, transfer pricing comes down to this. Countries want to make sure they're getting every dollar they're owed, and companies want to make sure they aren't paying any more taxes than what they owe. Buying the world of Coke is easy. Agreeing on who gets taxed on it, not so much.